Let's just be real for a second. You turn on the news, you see these headlines about war and global conflict, and it's scary. It just is. And if you're an investor, that anxiety can really hit your financial peace of mind. And it probably makes you ask one really big question. What on earth should I be doing with my money right now?
Okay, let's just tackle this one head on. This is the first thought, right? It's that gut reaction every single investor feels. Should I just sell it all? Should I just get out and hide in cash until this whole thing blows over? And look, that is a totally human response to fear and uncertainty. But here's the thing. When it comes to investing, gut reactions can be incredibly costly. So before we do anything rash, let's actually look at what the history, what the data really tells us.
So before you even think about hitting that sell button, I want you to look at this number. 75%. So what is that? Well, that's the percentage of times the S&P 500 was actually higher just 12 months after a major geopolitical crisis began. Think about that for a second. It's a really powerful and kind of counterintuitive statistic. It suggests that our first fear-driven instinct might be the exact opposite of the right move to make.
All right, so let's move past that initial shock and let's become data detectives for a few minutes. We're going to dig into the hard evidence from over a century of market history to see what really happens to stocks during these major conflicts. Okay, so check out this table because it reveals a really fascinating pattern. If you look at 20 major conflicts going all the way back to World War II, the market's initial reaction is almost always negative. No surprise there, right? On average, it's about a 6% drop. And yeah, some events, like the invasion of Kuwait, cause a much steeper dip. But now, look at that recovery column. On average, the market got back to where it was in just 28 days. In some cases, like the war in Afghanistan, it took only 3 days. The lesson here is pretty clear. The initial shock is very real, but the market's resilience is often even more powerful. So what's the big takeaway from all this? Well, while these geopolitical crises are undeniably tragic events, for the stock market, they have historically been temporary bumps in a very long upward journey. The engine of the market, companies creating value, innovating, adapting, that engine has proven to be incredibly, incredibly durable. Okay, so if the data is so clear, then why is our first instinct to just panic? Why does our brain scream, sell? Well, the answer isn't in some finance textbook. It's actually in our own psychology. So let's pull back the curtain on the mental traps that are kind of hardwired into our brains, pushing us to sell at the absolute worst moment. So this first concept, it's a huge one, loss aversion. Behavioral finance experts have proven this time and again. The pain of losing, say, $100 feels way, way stronger than the pleasure of gaining $100. So during a crisis, this bias just goes into overdrive. You get so focused on just stopping the bleeding, on avoiding any more losses, that the impulse to just sell everything becomes overwhelming. And in doing that, you lock in your losses and you risk missing out completely on the eventual recovery. And that loss aversion often gets amplified by a second mental trap, herd behavior. See, when we see everybody else panicking, our brain tells us, whoa, they must know something I don't. So what do? We follow the crowd. We sell when everyone else is selling. This creates this vicious feedback loop. It just amplifies all the fear and it drives prices down even further, totally disconnected from the actual fundamental value of the companies themselves. Okay, so we've established that selling everything is historically a pretty bad idea. But that doesn't mean a conflict has no impact at all. It just means the impact isn't spread evenly. You can almost think of it like a set of scales. Some sectors get weighed down while others can actually get a lift.
And you can see that divergence so clearly right here. On one side, you've got sectors like energy, which can see their revenues just soar as oil prices spike on fears of supply getting cut off. Defense companies, they often see a big surge in government spending. But on the other hand, industries like airlines get absolutely hammered by those exact same rising fuel costs. And consumer-focused sectors can struggle as inflation starts to eat into people's spending money. The key thing to realize is that the market isn't just one big thing. It's a collection of industries, and each one reacts differently.
So when investors get spooked by all this uncertainty, they don't always just sell stocks and hide their money under the mattress. They often start what's called a flight to safety, moving their money into assets they believe will hold their value or even go up. Let's take a look at where that capital typically flows. This is a classic pattern. When fear is high, investors look for a port in the storm. They seek out what are called safe haven assets. These are things that have a reputation for holding their value when stocks are going wild. And well, the most famous of these, of course, is gold. And here is the really good news. You don't need a giant vault in your basement to invest in gold anymore.
For a modern investor, it is easier than ever. What you're looking at here are gold ETFs, or exchange-traded funds. Just think of them like stocks that track the price of gold. And the key thing to notice, especially if you're investing with a smaller portfolio, is that expense ratio column. Look how tiny those percentages are, like 0.09%. That's the annual fee. It just shows how accessible and how low cost it is to add a potential hedge against stock market craziness to your portfolio. So we've gone through the data, we've gone through the psychology and the different sector impacts. Now let's put it all together into an actual actionable plan. This is how you move from being a reactive, emotional investor to a proactive, disciplined one. This is the schema, the playbook that successful long-term investors use. And the plan is beautifully simple. It's just 3 steps. First, know what you own. Seriously, if you understand the fundamental strength of the companies you've invested in, then scary headlines have way less power over you. Once you have that conviction, step 2 is to just keep your savings plan running. Automating your investments is your single best defense against emotion, and that consistency leads to the third and most powerful step. You have to reframe your mindset. A market downturn is not a crisis, it's a sale. It is an opportunity to buy the great companies you believe in at a discount. Now, let's zoom in on that automated investing piece for a second, the one known as dollar cost averaging, or DCA. And here's a fascinating little paradox for you. The data actually shows that investing a big lump sum of cash all at once leads to better returns about 2/3 of the time. So why is DCA so powerful? Because its real job isn't to squeeze out every last percentage point of return. Its job is to manage you. It automates your discipline, it forces you to buy when prices are low, and it keeps you from making those big emotional mistakes. It keeps you in the game. And staying in the game is ultimately how you win. And you know, all of this, the data, the psychology, the strategy, it all brings us to this one core truth. And it's captured perfectly in this quote from Warren Buffett. The historical data is clear. Crises pass, economies adapt, and it's the patient investors who are rewarded in the end. So the real question you have to ask yourself isn't whether your portfolio can survive the next crisis. It's whether you have the discipline to let it.